Hi, I'm Jimmy. In this video, we're going back to the investing basics. This time, we're looking at what an investing payback period is. So we're going to look at what a payback period is. We're going to look at an example or two. We're going to look at some of the advantages and disadvantages of using payback period. And ultimately, we're going to determine what's the best use for payback period. So the actual definition of payback period is ultimately how many years does it take to recover our initial investment. So let's look at a quick example. So we have Company X, and Company X is building widgets. Their initial investment in this project is going to be $12,000. Then what they have to do is they project out over, let's say, the next 4 years, how much cash flow they think they're going to bring in. Let's look at a quick illustration so we can see how the payback period really works. So each of these green bars represent how much they expect to bring in each of the next 4 years. So the question for us is, how long will it take them for them to recover the initial $12,000 that they invested? And that's quite simple. All we have to do is add up each of the years until we hit $12,000. In this example, we made the math quite simple, and the payback period is exactly 3 years. Now, of course, it won't always be that simple. If we look at this example, well, again, we start adding up the numbers, and we can see in this case, well, it takes a little bit more than 3 years, call it about 3.5 years, for them to get their initial investment back. The first example, we had it end mathematically right at 3 years, but very rarely will that really happen. Either way, this is interesting information to note. Ideally, the lower the payback period, the better. Okay, now let's jump into some of the advantages and disadvantages of using payback period as a tool to help make investment decisions. So on the advantage side, there's two real simple ones. First, it's simple and easy to calculate. It's quick, it's easy, it's fast. Simple math will get you there. It can also help lower our risk. That's another advantage. If we try to stick with investments that will lower with the lowest possible payback period, in theory, although it's simple, it could do a good job of at least guiding us in the right direction. Then we jump over to disadvantages. Now, both of these disadvantages are pretty big ones. The first one is that payback period ignores the time value of money. Let me illustrate real quick. So if we jump back over to our chart here, we lay out $12,000 and we're assuming that our investments are going to bring in $4,000 each year. Well, it's not right to say that the money coming in year one is worth the same amount in year 4. Inflation alone would likely make that not true. Money today is worth more than money down the road. So the fact that the payback period is ignoring the time value of money is a problem. Now, if you're curious, I actually did a video, one of my first videos on YouTube, on what the time value of money is. So if you'd like to learn more about that, I will leave a link to that in the description below. Okay, on to our next disadvantage, and this is another big one. This one is that the payback period ignores some cash flows. It skips them all together. Let me illustrate real quick once again. So this is going back to our very first example. And we saw in our first example that if we add up the numbers going in time order, well, our payback period is exactly, in this case, exactly 3 years long. But clearly this ignores this fourth year here. This fourth year, they're bringing in $6,500. But what if that wasn't $6,500? What if they were, in fact, bringing in, let's say, $10,000? So instead of looking like that, it looked like the $10,000. Clearly, the second investment is better, but the payback period doesn't change because the payback period starts at the beginning of time and adds up until it hits $12,000, our initial investment. So it really, the disadvantage for the payback period is it's really ignoring any additional cash flows after the initial payback period, but it's also ignoring if the company has to lay out more money down the road. That could also be a problem because that would be skipped. So now we might ask the question, what's the best time to use the payback period, keeping these advantages and disadvantages in mind? Well, one place it's not good for is if we're trying to measure profitability. We already saw that they skip some cash flows, they ignore the time value of money. It's not good. It's not a good measure of profitability. But where it can be used is it could be a good measure of liquidity. So let's imagine that we knew we needed money in 3 years for some investment we plan on making in a few years. Well, if we know if we expect to get our money back in the next couple of years, well, this could be a simple and quick calculation we use to try to gauge that. it could make sense there. But I think this works best for, let's say, projects we're doing, or, short-term projects, not really to measure investment possibilities. If we're using this to try to say, hey, should we invest in stock A or stock B? That's very tricky to pull off. And I think we're better off keeping this out of that realm. It might be better for internal projects for a company or for a business or for, home expenses, something along those lines. Now, if you're curious about researching stocks or doing more in-depth dives on companies, including coming up with a fair value for those companies, I actually did a video called The 8 Steps to Analyze a Stock. If you'd like to watch that one next, I'll leave a link right here. I'll leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.